Welcome to the Deep Dive. We cut through the noise and get you the insights that matter.
That's the goal.
Today, we're digging into the second quarter 2025 earnings call from Metropolitan Commercial Bank. Our mission, as always, is simple. Filter out the fluff, give you the key takeaways, and get you up to speed fast on what happened and really why it's significant.
Exactly. And what a quarter for a Metropolitan Commercial Bank. I mean, the call really hammered home a sense of strength, stability. It stood out. We're seeing major growth in some key spots and, frankly, some pretty interesting moves for shareholders. They didn't seem to get the memo about tough times for regionals, did they?
Apparently not. They really seem to be on their own path here. Just looking at the headlines, strong earnings per share, really impressive loan and deposit growth, continued expansion of their net interest margin, which we definitely need to talk about, and yeah, that historic dividend, first ever.
That dividend's a big one.
It really sets the stage for us to unpack the drivers behind these numbers and what management's thinking strategically.
Okay, let's dive in then. Financial highlights for Q2 2025. Starting with earnings per share, EPS. They reported $1.76. Strong number. But what's really striking is that's up 21% from Q1. So real momentum quarter on quarter.
Yeah, 21%, a significant jump. And that momentum wasn't just, on the earnings line. The balance sheet grew too. Their outstanding loans up $271 million. That's 4.3% growth just in the quarter.
Healthy.
And critically, how did they fund it? Core deposits were up $342 million, or 5.3%. That's a really good sign. Suggests they're pulling in stable funding.
It really does. But the thing that really jumps out, maybe the most compelling part of this whole story, is their net interest margin, the NI. It expanded again, another 15 basis points, up to 3.83%.
Right.
And here's the kicker. That's the seventh consecutive quarter they've expanded margins.
Yeah,
seventh.
In this environment.
Exactly. While so many other banks are fighting margin compression, how are they doing this consistently?
That really is the key question, isn't it? I mean, that kind of consistency, especially now, it points to some seriously disciplined management. And it's not just NIM, tangible book value per share that climbed over 4%, hit $68.44.
10th straight quarter of book value growth.
10th straight quarter. You just don't see that kind of steady build in value very often.
You really don't. And their capital moves this quarter. They definitely underline that discipline. They finished off a $50 million share buyback program, getting shares back well below tangible book.
Good timing on that.
Right. And then immediately they turn around and announce a second $50 million buyback program. But the real headline grabber, like you said, was the dividend. First time ever for them as a public company. What signal does that send? Especially for a bank that hasn't paid one before.
It's huge. It signals maturity, right?
Yeah.
Confidence. They believe they can generate consistent profits and actually return some cash to shareholders, not just hoard it all for growth. It's like a vote of confidence in their own future outlook.
Yeah, well put.
Okay, so we've got the impressive top-line numbers, the capital actions. But, the real meat is often in the details, the balance sheet, the operations. Let's get into that loan book. Total originations and draws were around $570 million. And the weighted average coupon, the WAC, basically the average interest rate on those new loans, net of fees, was 7.72%.
Healthy rate.
Very healthy. And what really caught my eye was the big jump in floating rate loans, almost half of the new volume this quarter.
That's a very deliberate move, I think, especially since their overall loan book has a relatively short duration. Management talked a lot about focusing on repricing the back book, the older loans. Just in Q3, they have about $500 million maturing with an average WAC around 7.47%. Big repricing opportunity there.
Right, into these higher current rates.
Yeah, exactly. And crucially, they made a point of stressing, really, that they have not loosened credit standards. No changes to underwriting to chase that growth.
That's key.
Yeah. Pipelines are strong. They're still projecting over 12% loan growth for the whole year, but doing it, they say, the right way.
Maintaining discipline in a competitive market. That's important to hear. Okay, let's flip to the other side. Funding. Deposits. You mentioned core deposit growth was strong. It was concentrated in municipal, trustee, and lending verticals. What does that tell you about their model?
It shows the diversity, the depth of their funding sources. It's not just one channel. And the bank expects that core deposit growth will basically fund most, if not all, of their future loan growth.
And they're growing deposits efficiently too, right? That cost of funds number was surprising.
It really was. The cost of their interest-bearing deposits actually fell 13 basis points. Total deposit cost down 7 basis points.
How in this environment?
Mix shift was part of it, but also some active hedging. They mentioned executing a $500 million pay-fixed OIS swap back in April.
An OIS swap? That's an overnight index swap.
Yeah. Exactly. It's a derivative they use to manage interest rate risk. This one locked in a rate of 3.52% versus floating Fed funds index deposits. Pretty sophisticated stuff for treasury management. They're even forecasting using a target rate of Fed funds minus 75 basis points. Plus, they managed to reduce their more expensive wholesale funding by about $100 million.
Okay, so that hedging and shifting the mix really helped keep costs down. That's quite an achievement when everyone's fighting for deposits. How do they see themselves competing? What's their edge?
They talked about focusing on those diverse deposit verticals we mentioned and running what they call the lean franchise model. Their view seems to be that some competitors go for these big, expensive team acquisitions, basically hiring teams of bankers just to bring deposits over. That creates internal competition, high overhead.
Right.
MCB seems to be avoiding that, sticking to a more organic, relationship-driven approach. It probably explains a lot about why their cost of funds is behaving so well.
That lean model idea, that's a really interesting differentiator. Okay, let's circle back to the net interest margin then. Current NIM, 3.83%. They expect it to expand even more.
Modestly, yes. As those loan yields keep ticking up and funding costs stay controlled or even decline further. In fact, they actually bumped up their full-year NIM guidance. They were at 3.75%. Now they're guiding to approximately 3.80%.
And notably, that forecast assumes only one 25 basis point Fed rate cut, right? In October.
That's right. They're not relying on a big easing cycle to hit that number.
Makes the guidance seem more robust.
It does. And they also gave sensitivity. Each 25 basis point cut in the Fed funds rate should add about 5 basis points to their annual NIM, all else equal. Very clear guidance there. They seem well positioned if rates do come down.
That operational efficiency, the clear guidance, makes you wonder about their tech. Are they investing there to support this?
Oh, yeah, definitely. They're continuing to invest pretty heavily in a new franchise-wide technology stack. They did acknowledge a bit of a timeline shift. Full integration is now expected by the end of Q1 next year, a little later than planned.
Okay.
But they sounded very confident that this tech investment will support and scale the bank for years, and importantly, without blowing up the budget. It's a strategic, long-term efficiency play.
Makes sense. Okay, the elephant in the room for any bank, especially one growing like this. Asset quality, any cracks showing?
According to management, absolutely not. They reported excellent asset quality. No broad negative trends anywhere, not by loan type, geography, or industry sector. They also mentioned they're actively talking to customers about market stress, things like potential tariff impacts, and they're just not hearing specific concerns yet. It says a lot about who they're lending to.
Okay, but the provision expense did go up. $6.4 million for the quarter, up almost $2 million from Q1. What drove that?
Right. They said it was mainly two things. Continued loan growth, which naturally requires more reserves, and slightly worse macroeconomic forecasts feeding into their CECL model.
CECL, that's the current expected credit losses model.
Exactly, that forward-looking accounting standard. Plus, there was a specific reserve of $2.4 million for one single loan that went non-accrual.
Okay, so mostly growth and macro, plus one specific issue.
Yeah. And despite that, management seemed pretty confident they'll resolve a good chunk of their workout loans successfully this year. They kept coming back to disciplined underwriting, portfolio diversity, relationship banking, the core strengths.
Got it. So let's quickly run through the income statement highlights again, just to put it all together.
Sure. Total revenue grew 8% from Q1 up to $76.2 million. Net income was $18.8 million. That's up over 15% from the prior quarter. Solid growth.
And the main driver was net interest income.
Absolutely. NII was up $6.7 million, or about 10% quarter over quarter. That was driven by more loans on average, and crucially, that lower cost of funds we talked about.
Okay. And non-interest income, expenses.
Non-interest income was down about $1 million. But that was mostly noise, a one-time fee recognition in Q1 that didn't repeat. So not really a trend. Non-interest expense was basically flat at $43.1 million. Some moving parts in there. Seasonal dip in comp and benefits, a drop in professional fees they think will stick, but offset by some one-time IT project costs for that tech upgrade.
Okay. And they gave guidance for expenses going forward.
They did, expecting operating expenses to average around $45 to $46 million per quarter for the rest of 2025, all in, and the tax rate should stay around 30%.
All right, clear picture on the P&L. Let's zoom back out. Strategic outlook, shareholder value.
Yeah.
What's the plan? Any talk of raising capital?
Management said clearly, no plans to raise capital near term, though they always keep evaluating. And on buybacks, given where the stock is trading, they signaled future buybacks will likely be, quote, very limited. They're not looking to chase the stock higher with buybacks, especially not above tangible book value. Sounds like more of a strategy to support the stock below book.
So pragmatic on buybacks.
Yeah. And while they said that dividend and buybacks aren't the main goal, it's clear these moves are part of demonstrating financial strength and a focus on long-term shareholder value.
Makes sense. What about future growth areas? They exited that GPG business, right? Need to replace that fee income somehow.
Yeah, exactly. They're very focused on that. They see strategic opportunities coming in 2026 to ramp up fee income, either organically or maybe through acquisitions. That's definitely on the radar. Loan mix-wise, Q2 was heavy on commercial real estate, like 90%. But they expect that to balance out by year-end with more C&I lending, including healthcare.
And on the deposit side, more growth expected there.
Seems like it. They're still pushing into municipal markets in different states. They see growth and stability there. And other verticals like EB5, Title, 1031, those specialized real estate and investment areas, they said those have significant pipelines too. It really feeds back into that diversified deposit strategy.
Okay, one last specific point. They addressed some concerns about potential impacts on their skilled nursing portfolio from Washington related to Medicaid. What was their take?
Their interpretation was pretty straightforward. They don't believe the bill in question implies cuts to payments for residents currently eligible for Medicaid. They think the funding discussions won't actually impact occupants in the nursing homes.
So no material impact expected on their portfolio from that specific legislation.
That was their assessment. They feel the portfolio remains strong there. It was good they addressed it directly.
Yeah, definitely. So wrapping up their overall message, it sounds like consistency, discipline, and leveraging their model.
That's exactly it. Foundational strength, stability, diversified model. It all comes back to their core strategy. Strong underwriting, core funding focus, disciplined risk management, and playing to their strengths in the market. They sound confident they can keep growing prudently, whatever the economy does, while supporting clients and delivering decent returns. Very consistent messaging throughout the call.
All right, that brings us to our This Is Not Financial Advice segment. And we really mean it. This is just a thought experiment, pure speculation for discussion. Always do your own research.
Absolutely. Don't trade based on this.
Okay, so given Metropolitan Commercial Bank's, let's face it, pretty unique performance, especially that consistently expanding net interest margin against the industry grain, here's an outrageous but plausible trade idea.
How about going long MCB? Maybe pairing it with a short position on some regional banks. Specifically, the ones you know are super reliant on those expensive, high overhead deposit teams we talked about.
Interesting. So the thesis is MCB's lean, diversified deposit model, plus that NIM expansion that seems resilient even if rates fall, that could lead to them really outperforming, relatively speaking.
Yeah, exactly. As their funding costs potentially keep falling, while others are still slugging it out in expensive deposit wars and dealing with higher operating costs, it becomes a bet on MCB's operational efficiency and their unique funding advantage.
A bet on their model being more nimble and sustainable in this environment.
You got it. A bet on strategic execution.
Okay, again, purely hypothetical, food for thought there.
So wrapping this deep dive up, we've looked at a quarter where MCB, really showcased discipline and that foundational strength. It's a pretty good case study, actually, for you, the listener, on how a bank can navigate a tricky environment and still deliver.
Yeah, we definitely encourage you to think about MCB's specific strategies, that deposit approach, the NIM consistency, the careful asset quality management. How might those things provide resilience, maybe even opportunity when markets feel uncertain? It really pays to look under the hood.
Thanks for joining us on this deep dive into Metropolitan Commercial Bank's Q2 2025 earnings call. Remember, understanding the why behind the numbers is crucial.
Couldn't agree more. Always do your own homework, especially with financial decisions. Thanks for tuning in, and we'll catch you on the next deep dive.